So Rick, welcome back with us. It's great to have you again. The last time we had you was in August, I believe, at the very first iteration of this conference. You were gracious enough to join us in the middle of a move. I don't even think you had your coat hangers up in your closets yet, and you managed to call in. So I wanted to thank you again for taking the opportunity to speak with us today.
Well, thanks for the opportunity to address your audience. I should begin with a disclaimer. Those of you who can see me can see that my face is a little discolored. This is not, those of you who know me well would suspect as a consequence of spousal abuse. In fact, this had to do with over enthusiastic and somewhat clumsy workout yesterday. So lest you think that I angered someone, it's more a function of incompetent workout.
Oh, there you go. Well, someone made kind of a cheeky comment. I bet he was fighting the silver squeeze.
I don't know why I'd be doing that, but anyway.
Yeah. Okay. So Rick, why don't we start out with, because it's just new, kind of fresh as of yesterday, some economic data came out with respect to inflation. Producer price index, I think it was around 1.3%, which is substantially higher than the expected result and the previous numbers, historically very high number. What are your thoughts on the inflationary environment? Are we starting to see this finally? You know, people have predicted this. What are your thoughts on that economic data?
Well, lots of comments, but I think we need to dig into the data a little bit. Everybody pays attention to the headline numbers. And I actually think ultimately that the consumer price index is more important than the producer price index, although the producer price index is obviously the leading indicator. The problem I have with the consumer price index, at least in the United States, is first of all, it's been adjusted over 20 years so that the numbers that you see today aren't concurrent with the numbers that might have scared you in the 1970s or 1980s. More importantly, I think, John, is that the consumer price index doesn't include tax. I don't know about you, but tax is a rather important part of my cost of living. I guess if I didn't have to pay the tax, I wouldn't bitch so much about the index. But the idea that you have a cost of living index, which doesn't include the largest part of most people's cost of living, which is to say the Commonwealth or government, is a bit odd. The second thing I would say is, although I'm an old cheapskate and I don't buy much, in terms of the US CPI rate, which is alleged to be 1.6%, those folks don't shop where I shop. Occasionally, when it suits them, they report the index, excising food and fuel. That would be okay, except for that I both eat and drive. So I want people to understand the indexes for what they are, which is to say largely a manufactured statistic. I'd like, too, for people to understand that at least with regards to precious metals pricing, inflation isn't the be-all and end-all of the reason that people buy precious metals. People buy precious metals historically because they believe that the purchasing power of their savings are under threat. And people's fears are forward-looking, which is to say, when people look at quantitative easing, the debasement of the currency, or if you did it, John, it would be called counterfeiting. And that makes people nervous about the purchasing power of their savings over time. More importantly, of course, debt and deficits. I don't know the appropriate Canadian number, but in the United States, at just the federal level, not state and local, we owe $26 trillion on balance sheet, 20 trillion net, and 140 trillion in the net present value of entitlements, things like keeping old folks like me healthy when something hits their eye, Medicare, Medicaid, Social Security. And we service that debt with a national income, which is to say taxes and fees minus expenses, that's actually negative $3 trillion a year. In other words, we don't service that debt, we increase it. Finally, of course, negative real interest rates. Negative real interest rates are not a force of nature. The idea that you would pay somebody to store your wealth for you while you deferred consumption and took the credit risk, particularly the credit risk from a debtor that's $140 trillion in debt and can't service their debt. The idea that the compensation that you would get to loaning money to an insolvent borrower should be negative is insane. Those three things together, I think, are responsible for the increase that we have seen in interest in precious metals. I also happen to believe that the excess liquidity that we see in the market and the artificially low interest rates will ultimately increase the CPI stated rate of inflation. But I think it's a less important statistic. I think the most important statistic with regards to precious metals and precious metals equity investors is the level of interest rates, negative real interest rates. Sorry for that long-winded answer, but it was a broad question.
Yeah. There was a question, you kind of touched on it a little bit. Your thoughts on all the stimulus. I mean, we had a $600 checks go out late last year, potentially another $1,200 going out soon-ish. Your thoughts on what that's going to do to, the economy, the commodity space?
Well, I think that the stimulus program is treason, frankly. My thoughts don't answer your question. I think that the economy itself and the market are being held together in some way by liquidity. I think it's important, too, for your speculators to realize that there's a big difference between two words in English. One is liquidity, cash in the system. The other is solvency, the ability to extinguish our liabilities. There's lots of liquidity in the system, lots of cash in the system, maybe less solvency. One of the things that ironically troubles the United States government is the fact that when they pass out all this free money, that while the government isn't saving, individual citizens are starting to do a smart thing. Rather than taking that money and going and eating and drinking, buying sneakers and yahooing, many of them are storing it in the form of savings, doing individually what collectively we're too stupid to do.
Okay. I wanted to get your thoughts on the Texas situation. I know you've mentioned in the past that you thought natural gas could be a big performer. Obviously, with the situation in Texas, I think it's shining a light on the renewables, the power from wind and solar, and maybe do you think that's potentially will make people rethink their reliance on some of the renewable energy, or do you think that's just going to continue forward unabated at the same pace?
Another big question. The big thinkers want renewables. And irrespective of whether or not they're economic, and by the way, they're becoming increasingly economic, they will continue, whether consumers want them or not. I think at age 68, frankly, that we're going to need more of all forms of electricity. There are 7.7 billion of us on the planet, and there are more every day. And the ascent of humankind, notice I'm politically correct, I didn't say mankind. The ascent of humankind is such that each of us individually, even while there are more of us as individuals, demand more and more power. There are in excess of 1 billion people on Earth that don't have access to electricity at all. They want it, and increasingly they're getting it. And the consequence of that is that demand for all power is going to increase. What Texas teaches us, more importantly than the fact that we can't rely on intermittently produced power, which is to say wind and solar, is that we need as a society to invest much more aggressively in the grid itself. There were parts of the United States that had surpluses of power at the same time that Texas had none. And an addressable grid and power that was priced according to demand would go an awful long way. The market itself is the best battery that's ever existed. Some places produce power, other places consume power. If we had the ability to efficiently distribute power, and if we also had the ability to price power to reflect the balance between supply and demand in any given locale, while extraordinary circumstances like the ones that we just faced in Texas would continue to raise difficulties, it would make a much more sustainable, much more durable energy market in the United States. There is room in the United States for wind. There's room in the United States for solar. There's room in the United States for nuclear. There's room in the United States for everything. We need the ability to distribute it, to store it, to get it from where it exists to where it's needed.
Okay. And with respect to improving the grid, like I've seen some crazy numbers with respect to how much it would cost to upgrade that infrastructure. Do you think that this would be a driver for those funds to actually, and I don't know where the funds are going to come from, but.
Well, we would need legislation which allowed, as an example, people who produce solar power in their homes to sell that solar power in the grid at varying prices depending on the demand for it. If that occurred, and if there were reasonable returns on capital employed to grid improvements, that is, if it became a utility-style investment, the answer is clearly yes. The estimates that I've seen of making a truly addressable, individualized grid nationwide exceed $8 trillion. But the truth is, if there was, as an example, a 7 or 8% unleveraged internal rate of return associated with the utility-style investment, that $8 billion, pardon me, could be raised quickly and efficiently. Now, there are some issues that society has to address there. If you price power according to its utility and according to its availability, power will be less available to poor people than it is to rich people, much like it is anyway. Mm-hmm. But the politics of a rational allocation of resources is, of course, problematic in the society that we live in today.
Okay. Question came in about the recent action on Robinhood and Reddit, their attempt to squeeze silver. What do you make of all, the power of social media, sort of the gang mentality, and the retail guy trying to, trying to take down the hedge funds?
Well, I think I need to say in the very long term that this whole circumstance of distributed information, peer-to-peer information, is a very healthy thing. When I was a young man, information all came from on high. Social information came from the government. Societal information came from NBC, CBS, ABC. Financial information came from the Wall Street Journal. Sometimes financial information came from the investment banks. The fact is that there were only a very few sources of information and paradigm. Now there are millions, which is to say that there's a market in information. And I think markets are very good things. Now, markets are messy, extraordinarily messy. And getting information from your peers, some of whom are extremely stupid, means that the onus is on you as a consumer to pick and choose the information and the paradigm that you assume. But I think it's a very healthy thing. The young investors who are receiving peer-to-peer information, which is guiding their investment decisions, will suffer from making the same mistakes that I made as a young man, getting the information from the top, which is to say, until you learn how to invest, until you learn how to speculate, until you learn how to make your mind overwhelm your emotion, you're going to get your ass kicked. That's what's going to happen, irrespective of whether you get the information from an investment bank or from some moron on the internet. The truth is that the market will win out, and sources of information, which is to say social media platforms that deliver, will over time squeeze out those social media platforms that don't deliver. I'm highly amused. In fact, I learned something 3 or 4 weeks ago. I've always believed that a company that was overvalued was overvalued. I didn't realize that from a trader's perspective, there was an asset that involved hedge funds being short more than the float of a company. I understand it perfectly well in retrospect, but I was taught to invest by knowing how to add, subtract, multiply, and divide. And I'm not being funny here. The idea that there is a trading opportunity that is completely unconnected to valuation is a truism, but it was a truism that was lost to me after 45 years of investing. And I'm delighted that at age 68, I can learn lessons from 19-year-olds.
Do you think, is there a threat to market stability from this, do you think, or will the issues sort themselves out?
I hope there are threats to market stability. Stability doesn't reflect markets, really. At some points in time, markets are supposed to be fragile. And the idea that investors believe that they can be or should be protected by anybody is silly. The idea, as an example, commonly believed, unfortunately, that you are protected as an investor by your government. All you need to do is remember the Enron scandal. You need to rely on yourself, and you need to rely on your instincts. Let's talk about the advantages of a stable or fragile market. Let's say that as a consequence of a trend which happens to be untrue on social media, that a stock that you really like declines in price from $2 to 20 cents. And let's say that the fundamentals around the company are unchanged, but the perception has changed. From my point of view, that's an unalloyed good. Something that I wanted to buy at $2, I now get to buy at 20 cents. And when the furor engendered by a group of morons who consider themselves to be securities analysts, but whose paradigm really has got a hunch bet a bunch, subsides, I have been able to take advantage of the herd mentality. So I continue to believe that extraneous items aren't responsible or not responsible for fragility. I think it's the nature of humankind really that introduces fragility and volatility into markets. I think if you prepare yourself both psychologically and financially, that you can take advantage of volatility rather than being taken advantage of by volatility. The whole circumstance that I often have in calls like this, where I talk about companies, if I talk about companies, where the conversation slavishly revolves around the share price, I find very silly. The price information, while it's easy to obtain, has no meaning if you don't have an opinion as to value. The fact that something is selling for $2 a share is a floating abstraction if you don't know what it's worth. If you think that something is worth $4 a share and selling for $2 a share, that's very attractive. If you think it's worth $1 a share and selling for $2 a share, it's unattractive. But if it's selling for $2 a share and you know it's selling for $2 a share and you don't know what it's worth, the number that you have focused slavishly on has absolutely no rational value. The truth is that most of the market participants in a market pay slavish attention to price and none to value. And that very lunacy, I think, is really the cause of volatility more than anything else.
Yeah, it really is a mindset, right? When it's going up in value and becoming increasingly more expensive to buy, there's that incentive to buy, whereas it gets cheap and everyone kind of runs for the hills.
That's true insanity. We buy consumer goods often relatively rationally. I mean, I know there are exceptions like Geffen goods where people want status from overpriced goods. But the idea that you have a company, again, selling for $2 a share, nothing fundamentally has changed with the company, but maybe a research report comes out and it goes to $4 a share. Nothing has changed. So the company is arithmetically half as attractive, and people like it twice as much. If you were buying a consumer good, a can of tuna fish, same can of tuna fish, and the price went from $2 to $4, you'd buy canned chicken. You'd boycott. You'd do something completely rational. So we buy things like food relatively rationally. In my case, probably I buy too much of it, but that's a different discussion. And we often buy financial assets very irrationally.
Yeah. A question here came in on precious metals. Presuming the Fed installs yield curve control, is the United States going to be Japan or will it be Argentina?
That's a bigger question than I. The United States, remember, enjoys the exorbitant privilege of being the world's reserve currency. My friend Doug Casey likes to describe the US dollar as being relatively attractive, which he says means it's the prettiest mare at the slaughterhouse. So we have the ability, in some senses, to export our problems to places like both Argentina and Japan. The ability which they didn't have. I'm not trying to say that the fiscal policy in the United States is absolutely attractive. I'm only trying to say it's relatively attractive. So my suspicion is that the fate that we suffer won't resemble Japan's fate or Argentina's fate, that we'll be the authors of our own demise.
Question on commodity and underlying equities. What do you think will be the best performer from now to 2025?
I don't know the answer to that. I think the most certain near-term performer will be gold because of artificially low interest rates, quantitative easing, and debt and deficits. Pardon my pun, the commodity with the most explosive upside, I think, is clearly uranium. It costs $55 or $60 a pound, fully loaded to make the stuff, and at least in the spot market, we sell it for $30. Now, the uranium equities have had an amazing move in the last 3 months, and I'm not suggesting that people go out and buy uranium stocks now, which, as you may recall, I was suggesting that people did in August. The truth is that I think that the run in uranium stocks has probably discounted any near-term move in the uranium price. But I suspect that if you give me the time frame that you gave me, which is to say to 2025 or 2026, that the uranium price, at least the spot price from 30, is at least a double. Had you asked me this question 3 months ago, the answer would have been simple. That would have been oil. With oil priced at US 30 or US $40 a barrel, when we're consuming on a global basis 80 to 85 million barrels a day and producing that same oil fully loaded at $55 a barrel, that was a simple no-brainer. For the Canadians in the audience, I still believe that high-quality condensate, and if you have some courage, gas producers in the Western Canadian Sedimentary Basin, not the little tiny ones that hope to be producing gas, but rather the real producers who are on the bottom of the cost curve and enjoy some market access, will be excellent performers in the next 2 to 3 years, your prime minister and the political elites in the East notwithstanding.
Yeah, they have a bit of a hate on for those of us in the West. I'm in the West, so. Another question, it's on uranium, Rick. I've been studying the Sprott report on uranium dated February 2007, when the spot price was $75 a pound. Do you remember what happened to the average market cap of these companies when the price rose even higher to $140 a pound? Can you please talk about that? And has Sprott prepared a similar report later in the year, and is it available?
A whole bunch of comments. The later part of a bull market is more dangerous, but it's always more dramatic than the beginning of a bull market. When you go into the hyper phase, the hockey stick phase, things go absolutely parabolic. There's no rational reason for this, but that doesn't matter. It always happens. So certainly the uranium equities in the period where the uranium price went from $75 to $140 did some very, very, very stupid things. The Canadians in the audience will note that the backside of a hockey stick graph is just as steep as the front side, but much less fun if you happen to be long. We have been, when I say we, Sprott, fairly aggressive purchasers of both physical uranium, at least in trust form, and the uranium equities for the last year and a half. We are somewhat less aggressive buyers of uranium now, or at least the uranium equities. What I can say is that I suspect that the increase in share prices for uranium equities will mean that at least the viable and probably the non-viable uranium juniors all rush to equity markets right now to raise money. So for those of your listeners who are accredited investors, those who can afford to participate in the private placement market, rather than participating in the equity market, you might want to wait and participate in the private placement market so that you can pick up a half warrant or a warrant in the circumstance that we see. This isn't a blanket recommendation. There's a lot of difference among the uranium juniors between, in movie parlance, the good, the bad, and the ugly. And if you don't have the ability to differentiate, or you don't have access to expertise from people who can differentiate, just stay out of the sector.
Okay. Question on your prediction for how long the pandemic will be affecting the economy.
Bigger question than I can answer. I don't know. I'm amazed that the impact on the economy hasn't been deeper. I've been amazed for 40 years the ability that governments have through introducing artificial liquidity to front-end demand in a market, which is to say to goose a market. Now, at some point in time, this becomes a technique that bites you. What you do when you stimulate an economy by introducing artificial stimulus is that you front-end demand, which is to say that you take demand that would otherwise occur in 2022 and 2023, and you use it in 2021. That feels good in 2021, but it begins to feel bad in 2022 or 2023. And if we don't have an economic rebound at that point in time that's driven by something other than liquidity, at some point in time, we run out of liquidity. And the circumstance that we face is much more serious than the circumstance that we averted. But the truth is that my track record with regards to calling this is almost unblemished by success. I joke that I've successfully called 17 of the last 3 declines. And rather than embarrass myself again and add another, at least metaphorical, black eye to the one that exists, I think I'll pass.
Okay. I guess you kind of touched on it already. Another question was, why is the market and the economy so disconnected? I think
Liquidity.
Yeah.
Clearly liquidity. Artificially low interest rates do two things. They artificially reduce a company's cost of capital, at least a company that borrows money. I suspect without fraudulent interest rates that the prime interest rate would be 250 basis points higher. So companies are enjoying an artificially low cost of capital. At the same time, that earnings multiples and particularly dividend multiples are extraordinarily high because of the very, very paltry yields available on other savings products. So we're in an equities market and a debt market that is distorted by artificially low interest rates. This can go on as long as confidence goes on, and confidence can go on until people get bit. And I don't know how long that lasts, but people need to be concerned. Historically, with regards to interest rates, the ascribed U.S. 10-year Treasury rate has been about 200 basis points positive, which is to say the real yield on the U.S. 10-year Treasury has been 200 basis points above the CPI stated rate of inflation. If the CPI stated rate of inflation right now is 1.6, traditionally the yield on the 10-year would be 3.6, and other yields would be a small premium depending on credit quality above that. Instead, the yield on the U.S. 10-year Treasury is about 110, which is to say, 250 basis points lower than it would reasonably be. If we had a reversion to mean, if we had a circumstance where the markets retook control of interest rates, a crisis in confidence and liquidity, I think you would see very, very, very different bond prices and very, very different equity prices. But whether or not that will occur is the $64 trillion question.
Mm-hmm. Question here: what assets and sectors have the most downside the next few years, or medium to long term?
Long bonds. If you take the US 30 year bond or other 30-year bond, Argentina was able to sell a 100-year bond. Argentina will default 7 times before that bond is due. The long bond market is the wildest and wackiest market I have ever seen in my life. You don't even need to have reversion to mean. If you just get some upward move in interest rates to the point where they're no longer negative, which remember, negative interest rates are not a normal phenomenon, the long bond market gets absolutely positively assassinated. The spread lender market, where people are using, in effect, bundling subprime credits and using them as collateral to form a prime credit, in a circumstance where credit becomes less available, those guys don't get hurt, they get killed. They absolutely positively go away. So I would be very concerned about investments in spread lenders. But very large capital consumers, where their cost of capital is floating, which is to say they aren't in the fixed debt market, and where the yields that they're enjoying are either fixed or floating with a cap, have a circumstance where the capitalized value of their distributions declines while their cost of capital increases, and the product that they get paid for in terms of the service they provide may fall too. That would be an extraordinarily difficult set of circumstance for a capital-intensive company that used the difference between the cost of capital and return on capital employed to sustain a dividend.
Are you bearish on any particular commodities, Rick, at all, or?
Not bearish so much as concerned about the fact that the junior resource equities have enjoyed such a dramatic rebound. In past bull markets in my life, the bull markets have followed a predictable pattern. The commodity moves first, then the biggest, most efficient producers in the space move. Then the second tier producers move, then the developers move, then the juniors, the penny dreadfuls move. In this circumstance, I think we've had a narrative driven market, which is to say that the leadership went directly from the biggest and the best
to the juniors.
Down to the juniors. And my nervousness is that the junior market is ahead of itself, perhaps substantially ahead of itself. I continue to believe that of the 2,000 perhaps juniors that are listed worldwide in the mining market, between explorers, developers, all that kind of stuff, probably not more than 300 are viable, which is to say that 1,700 at any price are non-viable. And a market that is ebulliently financing non-viable companies is in and of itself highly risky. Now, I'm not saying that people should avoid the juniors at all. The juniors have been extremely good to me, and I think commodity prices are going higher. But I think today, more than ever, securities analysis, rational approach to speculating in juniors is the only thing that stands between many speculators and the precipice.
Okay. The question on so we were just talking about the juniors as a whole, question on junior mining. So it would be companies that are smaller but are producing, and the royalty space. Your thoughts on junior mining space and the royalty space?
In general, I like the royalty space. There's been a proliferation of juniors in the royalty space because they could raise money there. The royalty companies too are priced at a premium to their operating peers, and they should be. Margins in the operating space are traditionally sub 20%, and returns on capital employed unleveraged are often substantially less than 20%, while margins in the royalty and streaming space are frequently at 80% or better. And you would pay more for an 80% margin business than you would for a 15% margin business. That makes absolute sense. It is true, too, that some of the junior royalty companies have a negative cost of capital, which is to say their market capitalizations are substantially in excess of the net present value of future cash flows from their royalties. But on balance, a speculator who constructed a portfolio of royalty companies, while he or she may not enjoy the leveraged upside that some of their more aggressive peers would take, would have a better risk-reward ratio over the 5 years of a bull market than people who weren't in the royalty and streaming space. I wouldn't say that your listeners should buy a royalty company because it's a royalty company. I think that your investors should look at the royalty company's balance sheet, which is to say, do they have sufficient dry powder to grow? Look, too, at the net present value of their assets. Now, you're never going to get this right, but the fact that you try means that you're going to get closer than 80% of your competitors who don't know what the words mean. If you decide that the net present value of the royalty portfolio of a junior is $200 million, and that company is selling for $225 million, as an example, and you think that commodity prices are going to rise so that their free cash flow can rise, you have, on the face of it, a fairly sensible speculation, particularly when you compare it to an exploration company with a 200 million market cap that has very little chance of getting in production and developing any net present value ever at any commodity price.
Okay. A few questions came in here, Rick, on Bitcoin. Do you think Bitcoin or any of the cryptocurrencies will eventually play the role of gold as a safe haven? And just sort of a follow-up to that, will the Bitcoin market surpass gold, or would they move together?
My belief is that they're complementary rather than competitive assets. The market capitalization of gold and gold mining companies relative to the total of savings and investment products worldwide is de minimis. It isn't even a comment. And it's bigger than Bitcoin, which is to say that they're both fringe assets. They might be important to this audience, but in terms of the global economy, they have no significance whatsoever. They are, in my mind, very different asset classes. I suspect that they compete on the fringes, which is to say the narrative-obsessed part of the gold crowd, who thinks, as an example, that the silver price might go to $300, might be victimized by the Bitcoin crowd, who thinks that the Bitcoin price is going to go to $100,000. In other words, for people for whom volatility or the perception of volatility is a substitute for utility, there will be some competition. It's interesting that the utility in Bitcoin has had to do traditionally with its frictionless nature, which is to say the low commissions involved, with anonymity and its function, the function of the network in terms of a medium of exchange. What's interesting in the Bitcoin market today, and by the way, I'm pro-Bitcoin in the very long term, or at least pro-crypto. What's happened very recently is that the upside volatility in Bitcoin has limited its utility as a medium of exchange. Unless your life is denominated in Bitcoin, if your life is denominated in Canadian dollars or US dollars, when you use crypto to buy a sack of groceries, you don't know what you paid, and the grocer doesn't know what he or she received because of the volatility. It's odd, too, that if you look at the range of utilities around Bitcoin, and you see the fact that Bitcoin has gone from, say, $10,000 to $50,000, given that the utility hasn't changed very much, arithmetically, Bitcoin is about 20% as attractive as it was 6 months ago, despite the fact that it's much more popular. So I'm extremely attracted to blockchain and distributed ledger technology. Sprott has invested millions of dollars in applications around the blockchain and the distributed ledger to facilitate the ownership and transfer and storage of both gold and silver. And I believe ultimately that blockchain technology, the fact where you trust your peers rather than trust a financial intermediary or trust your government, as a medium of authentication of the good and authentication of ownership, is an absolutely world-beating technology. I think that blockchain technology will extend to lending, to property, to equities, to debt. I'm just not sure in the near term that the people who own Bitcoin, in every case, understand what it is they own or why, in fact, they own it.
Okay. Do you think there are too many ETFs and levered and not enough closed-end funds, closed-end fund ETFs?
I think there are too many ETFs. The truth is that the financial services industry will produce too much of whatever they can derive a fee from producing. And a circumstance where, as an example, in some markets there are more ETFs than there are underlying securities only strikes me as funny. I think ETFs are a wonderful vehicle, but I don't think they're a be-all and end-all. Investors who invest in ETFs need to understand something about the construction of the ETF, and they need to understand something about the underlying securities in ETFs. Where you didn't ask me this question, but I'm going to use your question as a platform for a statement. The part of the ETF market that absolutely terrifies me is the high yield part of the ETFs, the junk bond markets. Junk bond ETFs, high yield ETFs have become extremely popular with investors. And while the ETFs themselves are extraordinarily liquid, trading in some cases billions of dollars a day, the underlying securities that they own are often completely illiquid. If we had a circumstance where we had a popular fear about credit quality and people began to sell those ETFs, we could have a very severe problem where the fund managers were forced to sell assets to fund redemptions, but couldn't find bids for the assets that they proposed to sell. In that circumstance, they'd have to sell off their best holdings and be left with their worst holdings. We used to have a saying in the illiquid markets when I was a young guy. We called things owl markets. An owl market is when you call your broker and say sell, and your broker says to you, to who? And I have this terror that the high yield ETFs will evolve into a to who market to the extent that we have a liquidity squeeze sometime in the future.
Okay. We're at 40 minutes, Rick. Are you okay for a couple more, or do you need to keep going?
I can go 5 if that works for you.
5. Okay, perfect. Just so a couple more questions here. Are the plethora of SPACs symptomatic of frothy market on the verge of bursting?
I don't know about on the verge of bursting. What I have found is that illogical markets can go on for much longer than I ever perceived possible. And while I think that SPACs are a fairly efficient construction for capital raisers, and in fairness, present some guarantees for investors, given that investors collectively can approve or disapprove of the acquisition, I think that the plethora of blank checks or blind pools is symptomatic of a market that's driven by liquidity rather than by fundamentals.
Okay.
Whether or not that's going to end anytime soon is a question for psychology, psychologists. And I don't even own a TV. I'm really completely disconnected to popular culture, so I couldn't answer that question.
Okay. We have not seen consolidation in the junior space that we thought we might have. That we thought might happen. Any thoughts on this?
Well, I think we are seeing consolidation, but we're seeing it above the juniors. The advance in the share price of the juniors has done two things. One, there isn't as much value to consolidate among the juniors. And two, the management teams that might have agreed to be consolidated to protect their shareholders are unwilling to do so, because to do so would sacrifice their salaries. And in a circumstance where they can raise capital from the market, remember, for many managements, true yield isn't dividends, but rather salary and emoluments for officers and directors. So the ebullient state of capital markets, I think, has served in the frothy end of the market to disincentivize merger and acquisitions. We are, however, seeing mergers and acquisitions really prolifically in the legitimate sector of the market. The recent apples to apples transaction with Endeavor and Teranga being a classic example, but also the growth of companies like SSR. So I would argue that we have been seeing mergers and acquisition. We have been seeing consolidation. We've just only seen it in the legitimate rather than in the illegitimate part of the market.
Okay. A question that I think a lot of newer investors to commodities have, and I'm going to play off a point. I heard you talk about at VREC in 2020, talking about your story, the bumper sticker you see in Texas. I think, Lord, just give me one more bull market and I won't miss it this time. If somebody has stayed away from commodities so far, and they're looking at the commodities market and saying, wow, uranium, these companies are up 3 times and all the gold juniors are up. Is it too late for them to dive headfirst into this?
No, but you need to enter with discipline. In my experience, bull markets are very long-lasting affairs, and they have spectacular dimension too. That said, they're extraordinarily volatile. If I said to an investor, if you put $100,000 into a broadly based basket of commodity producers now, my suspicion is 2 or 3 years from now that you would be happy. My suspicion is also 2 or 3 months from now you might be unhappy. And so your own psychology determines what you will do. I continue to believe that rational investors and speculators are better off being exposed than unexposed. But I wouldn't be taking, as an example, if somebody intended to build a $100,000 portfolio a year ago, I would have said, jump in, the water's fine, go your best lick. In this circumstance, I might suggest starting with 50,000 and averaging up or averaging down over the course of a year, as the case may be. The last 3 months have been extraordinary in the commodity space, and I don't just mean in the gold space. I mean, the oil stocks are up by 50%. The junior uranium stocks are up by 100%. The copper stocks are up by 60 or 70%. I am loath to go all in a market that is as frothy as the market that we are in today. That said, when people say to me, have I missed the boat? In my experience, commodity bull markets are often 10-year-long affairs. In precious metals, we're 3.5 years into it. In broadly based commodities, we're probably 6 months into it. And in terms of dimension, while the energy markets, as an example, are up by 50 or 60%, I expect in the fullness of time, they'll be up by 200 or 300%. I know from experience, however, 45 years of talking to investors, that many people listening to this discussion today, were they to enter the market now and see the market 25% lower 3 months from now, would be shaken out of a position and would not be able psychologically to stay the trade and enjoy the gains that would accrue to them in the 3 to 5 year time frame.
Mm-hmm. Yeah, so they're getting in at a higher price point now. There's going to be volatility, and there's a chance of getting shaken out if you don't really believe in the underlying investment, right?
It would be useful if your listeners availed themselves, and I'm happy to provide it for them, of the Barron's Gold Mining Index. It's a 50-year chart. And I wouldn't want them to look at it with regards to technical analysis, because I'm not a technical analyst. What I would ask them to look at it in the context of is being a visual aid to the anatomy of bull markets and bear markets. The fact that bull markets last 10 years, the fact that recoveries from oversold bottoms, even irrespective of markets, can be very dramatic. And the fact that bull markets feature 5, 6, 700% gains, but also have numerous instances of 15 to 20% volatility. One of the things that I like to do with audiences to explain why they should be in these markets is tell stories like Pan American Silver or Silver Standard. We underwrote them in the 90s at 50 and 72 cents a share respectively, and saw both companies in 6 or 7 years go from under $1 to over $40. 40-fold returns, not 40% returns, but rather 40-fold returns. In the case of Pan American, to be sure, where I studied it, 4 times during the period where the share price escalated from 50 cents to $45, the share price declined by 50% or more. So in order to enjoy that gain, you had to have the certainty of premise that you could withstand the pain associated with a 50% share price decline. I would suspect that the share price of both Pan American and Silver Standard during the period of time that I owned them declined by 20% or more, 10 or 15 times. So to the extent that somebody is going to participate in a market like this, they need to understand it's going to be a rodeo.
Mm-hmm. They need the stomach to ride through these
Right.
roller coaster. Yeah. Okay, well, Rick, there are a number of questions kind of outstanding, but I want to be respectful of your time. So thank you very much for joining us today. It was great to do the Q&A format. Always great to get your thoughts on the markets, and lots of stuff to talk about. We live in kind of crazy times, it seems. I'm sure other people in history have said that, but I honestly, some of the stuff that goes on in the markets right now, it just boggles my mind.
Well, it was a pleasure being with you. I appreciate the opportunity to visit with your audience, and I hope some of what I've said was useful to some of the people, and I hope that nothing I said was too offensive to any of your listeners.
No,
I don't need
put some steak on that. Put some steak on that eye there, Rick.
You know, whenever I get a steak, it doesn't get near my eye, unfortunately.
Well, listen, we really, really appreciate your participation, Rick, and your support. It's been great to have you. Thank you so much.
Pleasure, certainly. Thank you.
Stay well, stay safe, Rick, and hope that eye heals up soon.
Time's on my side.
All right.
All right.
Awesome, Rick.
Thank you.